I want to share a new concept with you called economic value added and how it increases your profitability. See, it's this really fascinating idea where Coca-Cola, AT&T, Quaker, Briggs and Stratton, some big companies used this in the 80s and 90s as it was becoming popular, and really different consulting firms called it different things, but a company called Stern, Stewart and Company out of New York City really popularized the term economic value added. What does it mean? It means really looking at the cost of capital. What do we mean by that? Well, it's really easy on your financial statements to see the cost of debt capital, right? I mean, you have interest. It's an expense. It's a line item that you physically have to pay. But what about when you use company cash, or you use investor capital, or you as the business owner are contributing your own money into your business? What's the cost of that capital? Well, if you think about your business as an investment and you think of your capital that you're putting in as investor capital, you want to see a return on that. You want to see it appreciate and be able to create dividends. So this idea of economic value added associated a cost of using cash. What they did is, instead of just saying, well, cash is free because there's no interest attached to it, they said instead, we are going to treat our cash as if it were debt financing. That means we're going to have an interest rate associated with that. And we need to make sure that every place we deploy this capital is going to be profitable and productive enough to be able to repay that as if it were repaying a loan at interest. You know, this spiked profitability because companies all of a sudden had to find ways to become much more efficient. Instead of just plugging the dollars in and hoping that it would generate revenue and that would somehow trickle down to profits, they had a plan in place to think about how they were deploying that cash and if that specific project was going to be productive and profitable enough to repay that cash as if it were a loan. So here's how it applies to infinite banking. So you might be thinking, how does this really apply to me? Well, what we want to do is treat our cash as if it's expensive capital, as if we ourselves were the bank, and we're evaluating the financial decisions that we make in our business as a bank would. Is this particular project profitable enough for me to warrant giving this capital so that I know I'm going to be repaid on a schedule with fixed payments at interest? We want to treat our cash with that much value. You know, this relates back to a concept that we talked about called opportunity cost, because the opportunity cost of debt financing is interest. The opportunity cost of paying cash is the interest that you can't earn because you stopped the compounding of that cash and you used it, and you can never replace that growth on that particular piece of cash again. But as you know, with infinite banking, there's a third way to deploy capital, and that is to be able to build cash inside a specially designed life insurance contract. And what you're doing is you are continuing to earn compounded interest uninterrupted for as long as you have that policy in place. Then you can borrow against the capital, use that capital in an investment or an opportunity, or even as an expense, and then repay a loan. You know, the way that it works is fascinating because of two things. Number one, you're continuing to earn uninterrupted compound interest inside that life insurance policy, whether or not you use the cash, because essentially you're being the bank. You're continuing to earn interest. You're not just paying interest. But here's the other side. As you look at, is this actually a good use of my cash value? Should I take this cash value and plug it into this particular investment property, or this particular business, or this particular piece of equipment in my business? You want to use those ideas of economic value added and say, is this project something that is going to be profitable enough, making sure that I have a plan to repay the principal and the interest? That makes you make much better financial decisions. Instead of just using the cash, you're thinking about its profitability. You can think of it this way as well. Maybe you have cash value in a life insurance policy and you're trying to say, does this make sense to use it for paying for college? Well, maybe your child who is going to college could say, well, I know that I'm going to go to college, and then afterwards I have a plan to have this type of career that would produce this income, and so I know that post-graduation, here's the time frame that I could repay that loan at interest. Maybe you think about a business that you could buy. will that produce enough capital and cash flow in the business to, within a scheduled time frame, repay the principal and interest of the loan? So that's two ways that infinite banking can help you implement economic value added and increase your profitability while allowing you to be the bank, keep control of your capital, and earn uninterrupted compound interest. Hey, I hope you liked this video. If you did, click the link in the description box below for more information. And don't forget to like this video. Share your comments, questions, and feedback in the comments section below, and don't forget to hit subscribe to our YouTube channel.